Let's move on to the housing section. We would drop this from our Tuesday show because we had to interview Jill Stein, but we didn't want to skip out on it because there's actually some good news. We want to make sure we include it in our show. Let's put it up there on the screen. Wall Street, quote, has spent billions buying homes. Now a crackdown is looming. So this is really good. It says that Democrats in the House and in the Senate have now sponsored legislation that would specifically force large owners of single-family homes to have to sell houses to family buyers. There's now a Republican bill also in Ohio to drive out institutional owners through very heavy taxation. Similar laws being considered in Nebraska, California, New York, Minnesota, North Carolina. Homeowners associations right now are also trying to crack down on investors from buying and renting out houses in their neighborhood. And all of the legislative proposals, quote, represent a new effort by elected officials to regulate Wall Street's appetite for single-family housing. So according to the Wall Street Journal, from the latest data that has come out, they have found that the highest level ever of single-family homes were purchased by investors by portfolio size in 2022, 2023, and 2024, respectively. And in each case, you're actually seeing a huge increase in the number of people who actually have over 1,000 homes inside of their company. From 2022 on, we've seen a massive expansion of that, Krystal, and even people who own between 100 and 99 houses. So what's happening right now is that you'll have smaller investor groups that dabble in this stuff. Then they get rolled up into a larger private equity group, people like Blackstone, BlackRock, and others. And the overall effect of this is that we have a huge housing shortage right now in the country. This is driving up the house. It also means that these people have tons of cash at their disposal and come in with an all-cash offer. But the danger is that when you gobble up all of the houses there in that market, you can stabilize the rent and increase it to wherever you want, drop services, and then more importantly, you know, a single-family landlord is somebody who at least usually lives in the same area. Maybe, you know, they can come over or something if the dryer is broken, you know, something like that. But when you're dealing with a corporation, you know, good luck getting your services.
That's right.
You know, and they're going to charge you double for something like that.
Yeah, and we've covered here the way that more and more of these companies are using algorithms to collude and, you know, extract higher rent from individuals in these markets. So basically, this is a situation that's bad for renters. It's bad for would-be homeowners who want to buy that first home. I'd say starter home, but starter homes aren't really a thing anymore, given the average price tag is just insane. And I think this is why this actually has a shot at getting through. It's also bad for existing homeowners who don't like that their neighborhoods are being bought off and turned into rentals because they feel like, you know, renters are less committed to the area, whether this is true or not. But it is true that you're less likely,
Some of this is NIMBY propaganda.
Exactly. That's, I mean, but that's the thing is NIMBYs are extraordinarily powerful.
Yeah, that's true.
Like actual homeowners are extraordinarily powerful. And so I think the reason why this has so much traction and actually has a shot at becoming something you have a little bit of bipartisan interest and support is because you've pissed off homeowners. They don't like this direction. So it's, you know, they don't like it for, like I said, you know, sort of questionable NIMBY reasons, but it is what it is. And then it's bad for would-be homeowners, it's bad for renters. So you put that up against, you know, on the other side, you have very powerful interest in terms of these like Wall Street firms that are buying up all this real estate, and it becomes an actual battle where you do have some powerful interests on both sides.
Yeah, absolutely. And the reason why this matters is that right now, housing affordability, again, is at near record low levels. So let's go put this up there on the screen. I wanted everybody to see specifically what's happening right now with mortgage rates, where we have seen a stabilization at 7%, which is incredibly high historically. It may have dropped a little bit over the last couple of months, but only by 0.1 or 2%. So we're now in a situation where if you have an 800 credit score, the best credit score that exists, you're still getting a mortgage rate of some 7.1%.
Wow.
And if you are in the average credit score, let's say under 680 or something like that, you're getting what, 7.3? At 720, you're getting 7.2. I mean, these are very, very high interest rates. And just to normalize that, I mean, if you put a 20% down payment and you do an average, you know, 30-year mortgage, the vast majority of your payments for the first several years are just going to be interest. You're basically just renting your house from the bank and building up like tiny little slivers of home equity, as opposed to if you have a 2 or a 3% mortgage rate like they had in the past. So this is the danger, is that right now, not only are you going to need that's 20% or whatever to avoid PMI if you're trying to put down something like that, but that your mortgage payment is going to be so high, even with a very, very good credit score, that it reduces the overall top line number of what is even accessible to you, making those banks even more competitive whenever they are working in this. And there is no sign of anybody coming to save you. Let's put this up there, please, on the screen. The Federal Reserve just announced yesterday that they will be holding interest rates steady. No sign that it will cut soon as the, quote, inflation fight stalls. That's questionable in terms of what all that means. But the bottom line is that the expected election day cuts that were supposed to come between now and November, it's not happening. Jerome Powell, from basically what Fed watchers and all those have shown, Krystal, they're not cutting until November, until after Election Day. So, by the way, whoever wins the election is going to be a lucky SOB because the economy is going to do super well after.
Biden was really hoping for these rate cuts.
He was hoping and praying. That's what they needed.
That's why it was really important, these last couple inflation numbers that came in hotter than expected and showed there, were still issues there. And instantly, a lot of analysts had been thinking that the Fed may well cut rates at the next session, and instantly that was basically off the table, and even the prospect of them raising rates came into plausible reality. But what we see here is they're holding rates steady. That means no relief for mortgage interest rates, no sort of like fueling the economy in the way that Biden would hope going into Election Day. And I do think, it's obviously it's extremely important politically, because as much as the abortion is incredibly critical and, very understandably emotional for a lot of people and very motivating for a lot of people, as much as the unconditional support for Israel is for young voters, especially, significant issue and probably going to drive a lot of voting behavior. Still overwhelmingly the issue that, many people say is their number one is the economy. I mean, this is classic politics 101. So the assumption that had been made here for at least a little while is that the economy was going to continue to improve leading up to Election Day. And now that picture is a lot fuzzier and a lot more challenging for Biden. So I'm sure he's not happy about this news. But the mortgage interest rates being the mortgage rates being what they are is pretty astonishing. And typically, when you have this sort of a situation, you'll see prices drop to reflect that increased cost. But because you have such a limited supply and, partly driven by some of the Wall Street acquisitions, but also just overall picture, it's meant that you haven't gotten that break. So it really is sort of worst of all worlds in terms of the housing market for people.
It's bad. It's also, it's just dry. Borrowing costs are so high right now. Good luck to anybody who's trying to get a loan or anything like that. Even a car loan. I mean, I think the car loans out there are like 13, 14% right now, which is wild. Yeah. Some of you Texans who are, the average car payment in Texas is like $1,200. Yeah. You guys need to stop buying such expensive trucks, man. Do you really need the big Dodge Ram or whatever it's, what is it, the Raptor? I see a lot.
Oh, the Raptor's fancy.
I was just down in Texas and I was looking around. I'm like, what do you, and out in my parents' suburban neighborhood, I'm like, what do all you people need a truck for? No offense. Like, I know that it's fun. It probably is, fun to drive, but what are we doing spending 70 grand on a truck when you're not hauling anything? If you actually need it, that's a different story. But my point is just that it's making fun in life right now. It's a little bit too high.
Probably most people who actually need it aren't getting like the fancy luxury ones. Like
I've always thought the same. Yeah, every time I see actual ranchers and all that, they're driving like a Toyota Tacoma or something that is unbreakable.
Like the F-150.
The F-150 is cool. I think it looks cool. It certainly does. But I've only driven a truck a couple of times. I'm not sure it's for me.
Hey guys, if you like that video, go to breakingpoints.com, become a premium subscriber, and help us build the best independent media organization on the planet.
That's right. We're subscriber funded. We're building something new. We want to replace these failing mainstream media organizations.
So again, to subscribe, it's breakingpoints.com.